guest. Richard, good morning.
Good morning, James.
Thank you very much for doing this. As I say, we're all sort of keen to know how Pantheon's new infrastructure fund is doing. So you've got a presentation. I'll let you sort of rattle through a few pages, and then we'll ask you some questions if that's okay.
Yeah, perfect. And look, thanks for having me today. Thanks. So on page 3, good morning, everybody. I just wanted to have a quick update on Pantheon Infrastructure PLC, or PINT, as we call it. It's hard to believe it's been about 6 months since the IPO back in November last year. If you recall, it was one of the largest investment trust IPOs for 2021. And what I wanted to do was maybe just give everybody a quick reminder in terms of what we're doing. So firstly, we've got a very good diversified shareholder base. I think that's played through the aftermarket post IPO. So a good mix across institutional, private wealth, and retail channels. We've got a really great board. You may not know, but all 4 board members come from an infrastructure operating background. So they all have that understanding of the types of assets we're investing in. And we think that's quite unique within the infrastructure subsector, AIC subsector. So that's quite interesting. They've all got in excess of 100 years across them on average, in total rather, across those 4 independent board members. We're, just to remind you, focused on investing in infrastructure assets. As you know, these assets typically benefit from long-term protections through inflation-linked cash flows, have strong defensive characteristics, and I'll take you through in a minute a bit more of the details of the investment policy. So far, we're making good strides in terms of building the diversification as we set out to do at the IPO across geography, sector, subsector, and we've got some really good, strong sponsors, which I'll talk you through later. Just to summarize, what we're trying to do here is target investments across the different sectors, subsectors, and geographies where we find the best relative value. And given our sourcing channels across more than 50 different GPs, 50 different sponsors, this allows us to be able to find the best opportunities at any one time and be able to execute on those. And we're also targeting returns in that 8 to 10 net return target with a 4p dividend once we're fully invested. And we'd expect to have some progressive dividend growth thereafter. Over the page on the investment objectives, you can see the diversification there, and we'll talk about that in a minute. Most of the assets, in fact, the vast majority of the assets we're looking to invest in currently, given the rather interesting investment outlook currently, we think that the current geopolitical and macro environment is well suited to the defensive characteristics of infrastructure. We've got a big investment team that's working hard to find interesting investment opportunities. And we've really focused recently on the more contracted cash flows with less GDP linkage, given where we feel we are in the cycle. We've also sought assets that have conservative leverage profiles so that we don't exacerbate any of the potential downsides that we might see. There's great inflation protection across the assets, which we think is really important in the current environment. There's some really good tailwinds within the infrastructure sector, as you know. So we're looking to provide access to the different subsectors, in particular focused on the transition to net zero. So that's across renewables, but also in particular the energy efficiency subsector, and then also the digitization of our society at the moment in terms of data centers, fiber, and mobile towers. And we've done an investment in all 3 of those subsectors within PINT. And what we're trying to do is create value through either operational or expansion opportunities within the various different assets we're investing. So this organic or inorganic growth is one of the key value drivers that we can bring to these assets. And then using the skill set and track record of our sourcing partners, to be able to deliver on that and make these accretive acquisitions, and then look to realize assets typically after about 5 to 7 years. We're also very focused on ESG, and that's something that really goes to the heart of what Pantheon is about. We were an early signatory to the UN PRI, and that plays out. And I'll talk about that in a little bit more in a minute. But just high level, we've got a couple of exclusion sectors, subsectors, and we're also looking to target an Article 8 from a TCFD classification perspective. Team on page 5. So we've got a collective experience across those 8 investment committee members, and that's a global investment committee with half the team sitting in London, half in San Francisco. On average, we've got over 20 years experience between us. So we've seen what's happened through the cycles, and seen what's happened when people have over-levered or overbid assets. And so I think that collective wisdom puts us in a good place to be able to position the company well going forwards. The investment manager, Pantheon, is a leading infrastructure platform. We've got significant scale, almost 19 billion so far. We've got an experienced team of over 25 individuals, and we're looking to provide you some further news flow there in terms of additional hires into the team. So we're looking to grow that to sort of 30 plus for the rest of this year. We've got a great relationship advantage. I mentioned the 50 or so infrastructure owners that we typically partner with. This gives us not just great access, but also an information advantage and access to high quality assets that are not necessarily available to the wider public. Over the page, on page 6, please. So I said I'd come back to ESG, just some very brief statistics there. So you can see the exclusion sectors in the middle across coal, upstream, midstream, storage of oil, gas upstream, nuclear and mining. And we're also going to have some strong targeted reporting and monitoring across the portfolio, as you can see across the bottom there. We're a strong supporter of TCFD. We've set up quite an interesting framework with a group called ERM, where we mapped our entirety of our portfolio across the wider assets that Pantheon owns. Within the wider Pantheon franchise, we're invested across about 700 assets previously, and we've mapped that portfolio looking at sort of the physical and transitional risks and opportunities within that portfolio, and being able to use that to define and revisit our investment strategy and approach to investment restrictions through time. So we think that's really powerful, and that lens that the investment manager has on the world. Over the page, what I wanted to do was just give you a quick snapshot in terms of where we've invested to date. So if you recall the 400 million, we've got a NAV at IPO, gives us a NAV of 391 post costs. We have invested, committed, or in closing across 250 million of assets now. The pie chart top left shows you the breakdown there. When we say invested, we mean that we have physically drawn the cash and invested. On the committed deals there, the 19%, that's where we have signed a binding agreement and are just waiting for conditions to be satisfied to be able to fund the asset. And then finally, 28% is in legal closing. So we're just in the process of getting those assets to sign definitive legal documentation. And that leaves us with about 36% of dry powder to be able to effect further acquisitions for the company. So 5 assets announced to date, with another 3 in closing. You can see the geographic diversification slightly skewed towards North America. We will always want to look at that relative value approach of finding the best opportunities across the subsectors and geographies. You can see within the sector diversification, the investments across power and utilities, digital and logistics. We have some interesting deals in the pipeline across the renewables space as well. And then bottom right, you can see some great blue chip names, which we have invested with, which I think will be familiar to many of you on this call today. So just a little bit of a deeper dive around the 5 assets we've announced and the 3 in legals. From a portfolio construction perspective, we're really pleased with the diversification we've achieved. And we've, as I said earlier, made an investment in each of the 3 subsectors in the digital space. So you can see there the second deal, Cyrus One, data center business in the US, the towers business, mobile towers business with Vertical Bridge, which is a deal we've been invested with over 7 years to date, and had an opportunity to do a follow-on investment there. And then the announcement from last a couple of weeks ago, which was the Delta Fiber transaction in Holland, which is a predominantly a fiber to the home and fiber to the premise business. So that takes me through sort of the main part of what I wanted to say today, James. And I think I think we're open to Q&A now.
Cool. So just easy one on this page then. So in terms of the kind of average deal size, that sort of 20 million to 40 million range, is that about right?
Yeah, that's right. What we're looking to do is build a diversified portfolio. So we want to make sure that we're not going much above 10%. We have the ability within the documentation to go up to a concentration level of 15%, but we want to remain diversified. I think diversification is beneficial. If there's any particular hits to a particular subsector, we want to make sure that we're diversified across different geographies or different regulatory regimes.
And then in terms of that geographical split, it's a global fund, but is it just developed markets, or can you do emerging markets too?
No, that's absolutely right. We are very much a developed OECD markets company. We take quite a narrow view of that. So if you look at all the transactions we've done before launching this investment trust, we have really focused and will continue to focus on really North America, Western Europe, and Australia, New Zealand.
Cool. Okay, thank you. Just going back to the board.
Yep.
Have any of the board got a sort of asset management type marketing or marketing background, or are they all just infrastructure?
So they actually have a wide mix of skill sets, actually. So Varn, who's the chairman, he comes from the aviation industry, has served with a number of the big airline groups, so sort of brings that transportation expertise. If I take the next one, Patrick, he's our audit chair. Patrick brings with him many years of experience of working at John Lang, so has kind of that global infrastructure investing background, and so very, very familiar with the geographies we're participating in. And he was also responsible for the IPO of one of the John Lang vehicles back about seven or 8 years ago. So sort of familiar with the listed space, which we think was a great addition to the skill set within the board. Anne joins us. She was a lawyer and headed up the projects team at Allen and Overy. So again, extremely knowledgeable about the infrastructure market globally, and some of sort of the risk frameworks that are put in place. So very, very interesting background from her, and very complementary to the other two. And then Andrea also has an investment trust background, having been at Greencoat. So she comes from a similar background to myself in terms of working in on the asset management side. Okay,
thank you. As you sort of deploy this, the money that you raised at IPO, so the suggestion here is that you'll end up with sort of roughly 10 assets, maybe a bit more than that.
Yep.
Will you be then gearing up the portfolio and adding stuff, financing it with debt?
Yeah, that's a great question. We have, I used to I used to work with another investment trust, and the tried and tested method is to avoid the cash drag that we've faced from IPO and use a revolving credit facility. So we are in the process of putting a revolver in place, and then we'd use that to effect acquisitions, and then through time, I'd probably look to come back to market to clear that down, similarly to other investment trusts, and look to tap the market for additional shares.
Cool. And then what's the sort of pattern with dividends? Because obviously you're not going to be earning revenues for the whole portfolio for a while yet. What's the sort of ramp up of dividends look like?
Yeah. So what we said at the time of the IPO is we would target a 2p dividend in the first year as we are ramping up, and then we would look to target a 4p dividend in the first full year following investment, so in the second year, and then a progressive dividend growth thereafter. So that is still the target and intention from the board. Okay.
If we look at a sort of typical deal, because you're investing alongside a manager, we've got some of the managers here like Macquarie and Apollo, those sorts of people. What sort of slice of a deal are you taking when you make an investment?
Yeah, it varies considerably. It depends on the scale of the asset. And so for the larger assets, so if we take Macquarie, because it's the first one there for the National Grid acquisition we made, then there we're taking a relatively small slice in percentage terms. But we are largely reliant on the sponsor to be affecting the business plan that we've agreed at the time of making the investment. There are negative controls in place to provide us minority shareholder protection rights across the assets. And then,
I know we've got some slides on some of the individual deals. If we just have a look at one of those then. So this is interesting, I thought, because sort of transport logistics sort of wouldn't strike me necessarily as infrastructure, but maybe you can explain why I'm mistaken in that.
No, and look, the definition of infrastructure changes through time, and I think what we've seen over the last recent years is that sponsors and ourselves have looked to evolve the definition of infrastructure to include assets that demonstrate the downside protection, the long-term, the inflation linkage, the certainty of cash flows through long-term contracts, that type of thing, and businesses that have a strong competitive moat around them. So it's really all about downside protection. So all the assets we invest in, we look very carefully at downside protection. So there have been a number of logistics assets, similar types of logistics assets acquired by other blue chip names. So Stonepeak, I2, Arcus have all made investments in a similar sector. So it's very much seen as a core part, I think, of the infrastructure market. You've got all the high barriers to entry through the operational complexity of these assets, specialized technology in the warehouse hubs, and just the scale of this business, and the relationships it has. And the other thing that we particularly liked about this was that food flows in Europe have exhibited very strong resilience to economic downturns. So that supports kind of that whole thesis of stable and predictable long-term demand fundamentals. The other really interesting thing is because of this temperature-controlled logistics warehouses and trucks, whilst the majority of the produce is taken from Southern Europe and taken to Northern Europe, the trucks are actually utilized on the way back by taking high-value goods. For example, pharmaceuticals that need to be transported in a temperature-controlled environment.
Okay, that makes sense. In terms of trying to make an investment, are you doing it competitively? Are you bidding against a number of other people? And does that affect the prices?
So again, as all these things, it varies from time to time. a number of transactions we would call competitive, and a number we'd say are at the other end of the spectrum, which is sort of fully bilateral. We would typically look to partner with the sponsors early on to be able to assist and help them take down the asset. We go in with our eyes wide open in a competitive situation. We want to partner with someone who has an angle. We don't want to be involved in situations which have a cost of capital shootout, for instance. So we want to find those opportunities where we can find the best risk-adjusted returns at any point in time.
So how many sort of deals are you looking at to get to make an investment? And there's sort of quite a big drop-off rate.
Yeah, we did share at the time of the IPO a funnel where we're executing on just about 5% of the deals that come across our desks. So there's a pretty big funnel. We are so very efficient at screening those deals and finding out the opportunity set. Some just don't fit because of geographic or sector, or just not displaying some of those downside protection or infrastructure characteristics that I mentioned earlier. But in the vast, and then we get down into sort of more detailed due diligence. We have to screen deals out because they're too small. Some are just too big and we can't meet that investment quantum, but the majority is because they're too small, they don't have the infrastructural characteristics. But once we've done some decent amount of work, maybe gone through the first phase of our investment committee, at that point in time, our hit rate is actually much higher. It's probably about 50% or so. And so in those circumstances, we might miss out on a deal because a risk that we uncovered during due diligence, but that's less likely. It's probably more because of that competitive situation or where pricing gets to at the end.
Sure. Okay. Here we go. Cyrus One is a data center. Mm-hmm. And I think there were some funds that were trying to launch that were just going to do data centers, but that didn't seem to happen. But it's an interesting part of the sector. Again, it's sort of another way in which the sector is broadening out. Can you sort of talk us through how this works for the portfolio, please?
Yeah, sure. Obviously, data centers are a key component of the sort of value chain in allowing us to use data either in the office, at home, or on our handhelds, and more broadly in terms of the Internet of Things. The three key subsectors being data centers, fiber, and towers. Cyrus One was an early mover. I think it's the third largest data center operator in the US, has a portfolio of over 50 data centers in the US and Europe for about 650 million of megawatts of capacity. I think what we liked about this transaction in particular is it targets the hyperscale market. So that covers players in the market which have much larger capacity demand, such as the large cloud service providers. So those are the names that you'll recognize, like Microsoft, Google, and Amazon. And the hyperscale market segment is very attractive for infrastructure investors, as this part of the market offers real long-term contracts, highly credit-rated counterparties, and very little customer churn. I think the other thing which we think is important in the data center space is just the power usage. So increasingly, that's an important factor in securing customer wins, and Cyrus One is no exception there, with plans in place to move to more sort of on-site renewable power installation opportunities. So either the development, say, of a solar park or storage capacity adjacent to the data center, or contracting power under long-term PPA agreements with other renewables providers.
For the portfolio as a whole, how does sort of the inflation linkage work? What sort of inflation linkage do you think you've got into the revenue stream in the existing portfolio?
Yeah, we'll be providing more details around that with our interims, which run to the 30th of June. So we'll be producing our interims in mid to late September. All assets need to do an inflation sensitivity as part of our underwriting. Those assets vary. If we look across the initial 5 that we've put into the portfolio, they all demonstrate very strong inflation protection. Some of those are implicit within a formula. So, for example, within the building blocks of the National Grid Ofgem regulatory environment, you have a specific inflation protection there. In the case of some of the other assets, the contracts with the end clients have, again, that inflation protection. And so, we think we built a portfolio here that is responding well to the current inflation environment and is positively correlated.
So, with this sort of current environment, very high inflation, would you expect that all of that would be reflected in revenue growth, or is there a kind of cap or a lag to that?
Yeah, so you would need to get into the detail of each of the underlying contracts. So there is, again, some variability. Some of these, most of the inflation is generally passed through on a backwards-looking basis. So you do have a little bit of a lag. But again, there are other factors at play here, which is the growth that we can execute on the assets. So if I draw the comparisons to, say, kind of long-term, very core infrastructure assets, PPP type assets, you have that sort of long-term inflation linkage contractually on your revenue stream, but it's very difficult to move. The revenue stream is set up front in many of these contracts, whereas for more economic infrastructure, we're reliant actually on delivering growth by inflation on the existing assets by all means, but also the growth we can achieve through either inorganic acquisitions, which we're able to effect at typically on more attractive valuation terms, or through organic growth of the underlying assets. So, for example, the towers business we invested in, there is a contractual sort of build to suit where we build out new towers for our clients, and then would look to get additional growth through getting additional tenants on our infrastructure, or through other optimization processes like maybe doing a ground lease buyout or the like. So
this National Grid gas transmission business is interesting. So is the whole thing going to be retrofitted to take hydrogen? Is that the plan?
So as ever, there's an evolution with the development of this asset. It is the UK's sole regulated gas transmission network, as you know, but also has a strong portfolio of gas meters, which is the unregulated part of the business. I think it does provide an interesting opportunity from a hydrogen perspective. It is vital in the shift towards low carbon heating that we continue to use gas, and the role of hydrogen in supporting that transition is very important. The alternative to hydrogen is to providing heat would be to electrify the UK's heat network. Now, as you'll appreciate, that would be very expensive. In fact, it's estimated it costs about 3 times as much than mixing hydrogen into the network. So we think that there are very strong tailwinds to mixing hydrogen with gas. The generation mix as well would need to, I think, put something like 5 times the current installed electricity generation on the grid if we were to do away with gas altogether. And it would also require a massive overhaul of the existing electricity grid. So you can see there are strong tailwinds for hydrogen. We invested in this asset on the basis of its current business plan, with a view to kind of a value upside for the business case for hydrogen.
Answering a question on this. Okay, great, thank you. I think we've covered an awful lot of ground, really. We could go into more detail, but I think that's not bad at all. Is there anything else that you think we should take away from this? There's a lot of different strands to what you're doing here in terms of the definition of infrastructure, and I imagine that this is a fund that could be an awful lot bigger than just even the 400 million that you managed to raise this time around.
Yes, I mean we're a over 19 billion business at Pantheon, so we're obviously a scale player. So we would hope to be able to bring that scale to this vehicle too, but we need to find the right investment opportunities to fit the investment policy of the business. So yes, we have aspirations, as you would well imagine. I think there's a rising investment requirement across the different infrastructure subsectors, where the deployment of private capital is going to play an increasingly important role in that global transition towards a low carbon economy, and also through the digitization thesis that we talked about. So I think PINT is really well positioned to be able to execute on that, and provides a differentiated access to a broad subsector of economic infrastructure assets.
Great, thank you very much, Richard. Very interesting, and we'll follow the progress with interest. So thank you.
Thanks, James, for having me.
We'll be back next week talking to the manager of Aberdeen New Dawn, and then the week after that we've got Civitas on. I thought we'd had on the show before, but it turned out we hadn't. So I think there's a sort of discounted opportunity maybe. I promised you another look at Vietnam, and so we're talking to Craig Martin. Obviously, the gap in between is going to be the Jubilee weekend, where everybody's going to be in holiday. And then I think we have somebody lined up for 17th of June now, but that will be disclosed to you next time. And then another first, we're going to be talking to the manager of Biopharma Credit, which is a very big fund that I think, again, people don't know that too much about. So thank you very much for tuning in today, and we will see you next week. Thank you.